I'm Charlotte McLeod with the Investing News Network, and here today with me is Rick Rule of Sprott. Thanks so much for being with me here today online for a change.
A pleasure, Charlotte. Thank you for arranging it.
Of course. So let's jump right into the questions. We actually last spoke about 4 months ago at PDAC. It seems like a very long time ago right now. Since then, we've seen COVID-19 become increasingly widespread. We've seen major reactions from governments around the world. Looking back at what's happened, I want to ask if you anticipated the level of monetary and fiscal stimulus efforts that have unfolded. It's a big question, but let's see where we go.
I will admit that I did not. I remember joking with you at PDAC that the biggest public health challenge there was alcohol poisoning. It turned out not to be correct. The circumstance occasioned by COVID-19 was certainly more dramatic than I had thought it would be. The level of fiscal response and the level of economic damage done is also substantially greater than I would have imagined. In your particular jurisdiction where you are now, British Columbia, for various reasons, I think the impact has been less severe than it's been in other jurisdictions. But the global impact, as an example, on demand for fuel and economic activity, and as you point out, the stupendous fiscal response has certainly, I think, changed the way all of us need to both behave and invest.
In what ways would you think it's changed?
Well, for one thing, there is a disconnect, at least in the United States, between Wall Street and Main Street. We have a rip-roaring stock market and even a very strong bond market as a consequence of liquidity in the system and artificially low interest rates. That's completely disconnected from the broad economy, which continues very weak. Unemployment above 15%, reduced demand, and there needs to be a reckoning. My own belief is that it's likely that it will reckon with the equity markets going lower. But I don't know that to be true. The truth is that they say don't fight the Fed, don't fight the tape. The idea that you could propel equity markets higher with excess liquidity, particularly with the Fed buying the ETFs, the indexes, directly, doing, quote, whatever it takes, one wonders if we can manage over a longer period of time the disconnect between politics and the market and the reality of the economy. The second thing, Charlotte, is that the whole circumstances surrounding the interview that you and I did in Toronto comes much more clearly into focus. We had talked about gold being in the sales of precious metals for various reasons. And we have seen post-Toronto that the market has taken note of those reasons. It's worthwhile, I think, reciting them. Quantitative easing, if you did it, would be called counterfeiting. And you would be put in jail. If they do it, it's called policy, and it's extremely popular. But quantitative easing debases the currency, and precious metals traditionally have done well over time when consumers and savers were concerned about the preservation of their purchasing power in their currency, debasing the currency, turning out trillions of dollars of false currency units does just exactly that. Artificially low interest rates, too, I think are good for gold in the sense that you aren't compensated for the risk that you take owning treasuries, and you aren't compensated for the time value of money, which makes bank deposits, as an example, but also US treasuries, less viable competitors for gold. And then finally, at least in the United States, but I suspect in Canada too, government deficits increase at the same time that government debts increase. So one must be concerned about the credit quality of the debtor that sells government securities. Those three factors, quantitative easing, debt and deficits, and artificially low interest rates, play to gold's favor. The fourth thing that we talked about in Toronto, and I think that you're just starting to see now, is the fact that gold and precious metals related assets as an asset class are very underowned. I read a story about 2 years ago where the market share of precious metals and precious metals related investments was somewhere around 1/3 to 1/2 of 1% of the savings and investment matrix of Americans. The 3-decade mean was about 2%. So if the combination of quantitative easing, artificially low interest rates, debt and deficits did in fact put some wind in gold sails, which I believe they will, the base from which we expand is very low. If we fashioned a return to the 3-decade mean, we would somewhere between triple and quadruple demand for precious metals and precious metals related assets in the world's largest savings and investment market. And that's exactly what I think is going to happen.
Okay, so you've described gold before as a way to hold insurance, like an insurance policy, and it sounds like that's the direction you're kind of going in right now as people see what's going on in the world. Maybe they'll be coming into precious metals. In times like this, it really definitely does seem like insurance is needed. But if gold is insurance, I wonder if is there ever a time to cash out? And probably it's not right now, but I'm asking because as we hear about prices moving higher and higher, some people I think are already starting to think about that next move.
Well, I think for people who own gold differently than I, for people who own it as a trading vehicle, they will need to take their own counsel. I will certainly, at some point in the time in the future, if my fears and suspicions prove correct, sell some of my gold, which is a different way of saying I will cash in some of my insurance policy. There will likely be other asset classes, particularly I think among the industrial commodities, that 3 or 4 years from now will be very cheap. And to the extent that I have managed to maintain the purchasing power of my investment portfolio as a consequence of my gold holdings, I will certainly at some point in time utilize some portion of that to reinvest in the market in other sectors of the market that are at the time less popular, and so for me, more attractive. Any form of insurance, unfortunately, requires a bad set of circumstances to get paid. Life insurance means, as an example, that somebody died, and gold is no different. But the truth is, when the gold price goes too high, it's already fulfilled its insurance function. At the same time that, following the analogy, the premium increases. And so at that point in time, probably precisely when the price of gold has justified the narrative and people are more attracted to it, one must exercise intelligence and common sense and sell some.
Okay. And I wonder if it's possible at this point to make any predictions about how governments around the world may unwind the measures they've put in place right now.
They're in a very difficult position. As you know, Charlotte, I have no particular fondness or sympathy for government officials. But the truth is they're between a rock and a hard place. Much of the electorate doesn't care too much about what happens 3 years from now or 4 years from now, doesn't care too much about debasing the currency, and doesn't care too much about negative interest rates because they don't have any savings. And those people vote. People are interested in the immediacy with very little regard for the future. And in that sense, perhaps the concept of a forward-thinking politician is an anachronism. He or she can't afford to be forward-thinking because forward-thinking people get put out of office. I know that sounds cynical, but I suspect that cynicism is born of 67 years of experience watching both political cycles and the economy. The measures that are being put in place, the bailouts of individuals, the bailouts of companies, artificially low interest rates, stimulus, are all as popular as they are damaging. And I don't understand how any politician would have the political will to do it. I also don't think that you become a politician if in your mind your solutions to problems aren't of great interest to you. something that increases the role of the state is something that increases the power of politicians. And the currency that politicians live for is power. So this enriches them psychologically. So both because these destructive measures are popular, but also because of the nature of the beast, I'm afraid I see more of the same.
Okay. I want to go a little bit more specific now and talk about what's going on in the mining space right now. Since the coronavirus outbreak, we've seen mine closures and slowdowns. We've seen exploration called off. But now we're also starting to see operations come back online. We're seeing some return to normality. What do you think the main impacts of COVID-19 have been on the mining space at this point?
As you point out, before the mining industry really had an understanding operationally how to deal with the challenges of this highly transmittable disease, a lot of operations were, out of an abundance of caution, I think intelligent caution, shut down. The industry is beginning to understand how to deal with this transmissible virus. I note as an example, in Congo, in Katanga, a place with severe public health challenges, Ivanhoe, thus far, building their Kamoa-Kakula copper mine with 3,000 workers in place, has 0 cases, which would suggest that the industry is beginning to learn how to enforce certain standards of cleanliness and certain protocols that will allow the industry to, I think, reopen gradually. We're seeing other circumstances. As an example, the shutdown of the Chuquicamata smelter by Codelco in Chile recently, that would suggest that we are still in the learning phase. I suspect the low copper price may have had as much to do with that shutdown, in fact, as the transmissibility of the disease. But overall, I think the industry has cause to be both proud and hopeful. Proud because very often management teams took the necessary action before they were forced to do it out of an abundance of concern for their labor force. Proud too, because operating protocols are being put in place that allows these operations to go back in production, and not coincidentally provides access to the commodities that the world needs and access to payrolls in places where that type of employment is desperately needed.
Okay. Similarly, I guess, what metals are feeling the most impact from the coronavirus situation? We've talked a little bit about gold. Have you seen any opportunities emerge given the change in circumstances that we've seen this year?
The only industrial material it seems to be holding in place is iron ore. The rest of the industrial materials complex, as you would expect with a broad-based economic slowdown, have been hurt. Had you and I been talking 6 weeks ago during a point in time when the oil price went negative, which is to say that owners of oil had to pay people to store their oil, I would have suggested to you that was an economic impossibility. But it says something about the dramatic nature of the economic slowdown that we faced, that we didn't have enough place to store the surplus oil that we were producing. I bring that up not merely to amuse your audience, but to say that many industrial materials, copper, tin, zinc, nickel, oil, gas, are related to the broad economy. And to the extent that the broad economy continues to suffer, I suspect that prices of those commodities will continue to be weak. If you consume less stuff, you make less stuff. And if you make less stuff, you need less of the stuff that is made of. So my suspicion is that until we come out of the backside of this slowdown, and I have no idea where that will be, that the non-precious metals commodities will continue to face challenges, and we're investing accordingly. I should follow on from that, though, and say that the prices of many of these industrial commodities, base metals and energy, were already below the total cost of production, which is to say that these industries were already in liquidation. One of the things that I've learned in my career is that after a period of time where an industry has been selling a product for less than the total cost of production, that the industry is in effect self-liquidating. And when you balance supply and demand by reducing supply, you reduce the industry's capacity to increase production. And when you get a rally in prices, which will occur, I don't know if it'll be 2 years from now, 3 years from now, 4 years from now, you get what is uncharitably described as a rip your face off rally. If the clearing price for copper was, say, 350, but the industry couldn't increase production, it would be easy to see copper go to 450 or 5, overreact, because it's such a capital intensive business. And the process by which you increase production is so long. So I think the message to investors and speculators, the bulk of your audience, is precious metals now, but get ready for 2 years from now, 3 years from now, 4 years from now, for a stupendous rally in industrial commodities. And for those people who are really contrarian and able to choose, in movie parlance, between the good and the bad and the ugly, you might begin to position yourself in the better names in anticipation.
Okay, let's see if we have some long-term thinkers here. You mentioned at Sprott you're investing accordingly right now, and that feeds well into my next question, which is, as a company that's in a position to be providing capital in these markets, what does 2020 look like for you? What situation are companies in when it comes to financing?
You know, Charlotte, it's odd being at Sprott right now. This is the circumstance that we've worked for 10 years. We're joking internally, because our business is fantastic. We're joking internally that we worked a decade to be overnight successes, which seems to be the way that it works. In the very near term, looking back 3 to 4 weeks, there is an abundance of capital that is returned to the junior equity markets. There have been any number of financings that have been live for 30 or 45 minutes, upsized and sold out. There's in fact a wall of money in the sector. And I suspect that in the very near term going future, the next 2 or 3 months, that we might see a circumstance where some of that enthusiasm fades. We have blown up, that's the wrong phrase. We have introduced so much positive sentiment and so much cash into the sub-billion market cap space in the last 4 to 6 weeks that I'm nervous in the near term about our being able to continue that. Longer term, I think with the precious metals prices, that works fine. One of the things I've learned is that people in our sector are unprepared for the volatility that's inherent in the sector. I refer often to the Barron's Gold Mining Index chart. And if you look at 8 prior recoveries from oversold bottoms over the last 45 years, what you will see is that when precious markets recover, they recover very dramatically in very large scale. But masked in that recovery is incredible volatility, which is a different way of saying that these markets can decline by 15 or 20%, the same way that you and I inhale or exhale. And while over the course of the recovery, if you look at the stock chart, you almost can't see that 20% decline. When you're living through it, it's terrifying. So my advice to your listeners and readers in the very near term is to buckle your seatbelts. Understand that a 20% sell-off is normal and natural. And if you have the courage and the cash, it represents a buying opportunity.
Sure. Any other themes you've noticed in the mining space as a whole this year that are developing?
The thing that's been most dramatic from our point of view is the sudden interest that non-North American, non-old, in other words, the increasing interest of people who look like you rather than me. We have graded now at Sprott, I 8,500 portfolios in an offer I'll make later to your listeners. What has changed is the number of interested parties from outside North America, the number of young people, and the number of women. For the time that I've been involved in precious metals and precious metals mining markets, the market has looked like me, old, fat, white, bald, and that's really changing. My suspicion is that given the strength of the precious metals narrative, as it gains a little bit of momentum, as it gains popular currency, I suspect that you're going to see what's now referred to as the Robin Hood crowd, the narrative oriented, speculative oriented, trading oriented millennial crowd into the gold space, and crowd particularly into the most volatile part of the gold space, which is to say the junior precious metals equities. I'm afraid that most of them are going to have very harsh experiences over time. Usually somebody learns a lesson in this sector their first time in a very expensive fashion, and I suspect these young traders will be no different. But I think it'll have a really dramatic impact on the sector, and I look forward to seeing it. I also think that the lessons will be well learned, and that the millennials will end up being very good investors because of their access to information, access to paradigm, and access to advice.
Okay, I don't know if you're going to believe me, but I had a question about exactly that, about these young people coming into trading during, I guess, this year, during maybe they've had some extra time. I don't know what spurred it. Because I do have the impression that you like seeing that. You seem to be interested in identifying new up and coming leaders. You've spoken in the past about millennials and investing. I guess I'll skip to my next question, which is, I guess, are they here to stay? And any advice? Do you have the same buckle your seatbelts advice for that crowd of new people?
I think for the millennials in particular that they need to buckle their seatbelts. One's first investing and speculative lessons are usually fairly harsh. I remember the lessons that I learned myself as a young investor and speculator when I was 22, 23, 24. So yes, I suspect those lessons are going to be hard learned. The whole concept is an example of a group of new investors and speculators coming in and running up Hertz in bankruptcy suggests that there's going to be some lessons that are going to be learned. But you know, that's normal and natural. I really think because of the access to technology and access to information, that the millennials 5 years and 6 years from now will be the best crop of investors that's ever lived on the planet. I think it'll be good for mankind. I think it'll ultimately be good for them. But I suspect that they're going to pay a very, very, very steep tuition for being, at least in the beginning, too speculative and too narrative oriented, not arithmetically enough oriented, not paying attention to the things like the difference between the price of a security and what the underlying company is worth. Those lessons will be learned. It's just that the education will be harsh and expensive.
Okay. All right. As a final point, I want to ask about your conference that's coming up, Sprott Natural Resource Symposium. It runs online, I believe, from July 22nd to the 25th. I wondered if you could tell me what you're most looking forward to about the event. And I would also love to hear about the experience of taking an in-person event to an online forum.
Well, thank you for that. As you know, we've put on this conference in one way, shape, or form for almost 30 years and looked forward to returning to Vancouver. But life got in the way. That's what happens. And so we have availed ourselves of technology with the view to putting this on virtually. There are certainly some advantages to doing it virtually. For one thing, our hospitality, food and beverage and travel expenses are much, much, much lower, which allows us to lower the ticket charge at the same time that we increase our content and programming expense, which I think is wonderful. The other thing it does is it frees us from the jail, if you will, of time constraints. One of the most frequent attendee remarks about our conference was that we offered too much choice. That at one point in time, there might be 5 workshops and they had to choose between one and they desperately wanted to choose 3. Well, you don't need to do that now. You can watch 2 or 3 or 4 sequentially. You don't have to be in them. In fact, you can watch them simultaneously and toggle between the 2 if that's what you choose to do. What will be interesting is how we manage the interplay between attendees. One of the things that's always been important about the Sprott Investment Conference has been the extraordinary quality of the attendees and the extraordinary knowledge that the attendees themselves had. The idea that all the knowledge in the room was on the dais being dispensed to the crowd was silly. And listening to the conversations that might have taken place at the water cooler, at the coffee pot, in the aisles, will be missing. I had an attendee last year tell me that watching Robert Friedland walk through the exhibit hall and watching Ross Beatty walk through the exhibit hall and paying attention to who they were talking to and why was worth the whole cost of admission. So it'll be interesting how the sort of more organic parts of the exchange of information play out. But I need to tell you, I'm extremely optimistic about the new technologies that we're able to bring to play into this conference. Will this one be seamless? No. But I'll tell you, if any of your people decide to sign up and become paid attendees at the conference, if for any reason they don't think they got their money's worth, I'll give them their money back personally.
All right. And any final words that you would want to leave people with as we
There
close
is.
out?
The best opportunity I've found for me to educate your listeners is to give them something of value. And the most popular lessons I have to give are three. First is a copy of the Barron's Gold Mining Index. I use that index because it's the largest and longest running gold mining equity index in the world. And I have a chart that I like to send people. A different chart that I like to send people is a 100-year commodity chart, which really tells us where we are in terms of the value of commodities over time. The offer that gets the most attention is that I am willing to personally rank all of your listeners' natural resource stock portfolios. If the listeners will go to a web link, sprottusa.com/rankings, put your natural resource portfolio on that web link, both names and symbols, please, and I will rank your portfolio 1 to 10, 1 being best, 10 being worst, and I'll make comments where I think my comments are appropriate. And I'll send that back on a no obligations basis, along with the Barron's Gold Mining Index chart and the commodities chart. Please be patient. I'm about 1,000 rankings behind as we speak. And so we update the rankings database continually, but it's a major, major, major chore. I really enjoy doing it. I've learned an awful lot about investors. I've been able to teach lessons to investors that they really took because they were personalized. They were about their own portfolios, which of course people are more than interested. They're fascinated in. But I think the combination of the lessons around the portfolios and the two charts are simply the best favor that I can do for the market as we speak.
Okay, well, that's a great offer. I do hope people would take advantage of that, although I also hope you don't get too buried in requests. We can leave it there for now. Thank you so much for being here.
As always, thank you for interviewing me, and thank you for being so well prepared for the interview. I enjoy that.
Okay, that's great. Thank you so much. I appreciate it.
Bye-bye.
Once again, I'm Charlotte McLeod with the Invest and Use Network, and this is Rick Rule of Sprott.